Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make a little money here. My job is not just to entertain, but I'm teaching tonight. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. You either believe in artificial intelligence, or you should just stay away.
Don't buy.
You trust NVIDIA and Jensen Huang, or you can just go own some drug stocks and some food stocks. And you know what? Why don't you just go buy some rails?
All aboard!
Nobody demands that you buy the so-called hyperscalers. If you don't have confidence in these AI stories, the whole investing world, look at this, all these stocks are your oyster. There's no need to obsess over this stuff. Welcome to the kind of zero-sum investing logic that has kept people from making millions upon millions of dollars because they live in fear. They only know to sell when stocks are going down and buy when they go up. And that is a terrible strategy if it's a strategy at all. You should never buy anything if you don't trust enough to buy more on weakness. Trust is how you benefit from stocks these days. Dow, like any other day, shot up 664 points. Trust. The S&P jumped 0.91%. Trust. And then Nasdaq gained 0.67%. You're not going to catch these gains if you don't trust. That said, if you go to own tech, you need to know the landscape. For example, everyone who's in the Magnificent Seven should recognize that they didn't become magnificent by missing quarters and screwing up. They didn't rise to these lofty levels by being fooled by other companies or being duped or dropped as vendors because they're second rate. Before I go into why I trust the people who run these companies, and here I'm speaking, of course, of Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, let me just say that there are literally hundreds of big capitalization companies that don't require a lot of fortitude to own. Today, Abercrombie & Fitch and Kohl's, two retailers, screamed higher on better than expected results, finishing up 38% and 43% respectively. Those are more like takeover bids than earnings surprises. We have Best Buy on tonight, and wow, what a quarter they reported. Nothing's keeping you from owning those stocks instead of tech. But as you may know from How to Make Money in Any Market, I am a huge believer in growth stocks. And none of those three can truly be considered a growth stock, at least not yet. These three and so many former growth stocks are what draws me to the hyperscalers for my charitable trust. Now, we own many stocks from other universes, drug stocks, aerospace, materials, data center builders. They have long-term growth stories. But they're not turbocharged with the resources of these gigantic companies. That's what always brings me back to the Mag 7. These stocks are prominent because of their success. The companies they represent have bountiful profits, which is why they could rise to their lofty trillionaire status in the first place. It's why I don't kick them out when they're down. In fact, it's why I might buy them for the trust. I'll admit that they have a bit of the Houdini in them. Tesla was a car company, and stock rallied as a car company, and then when things got very competitive in electric vehicles, the stock got hammered and hammered and hammered again. But when Tesla fell from the 400s to the 200s at the beginning of this year, an amazing thing happened. The stock, not the company, the stock, was always the same company, morphed into a chit in the great game of self-driving and robots. CEO Elon Musk simply changed the narrative, and the street bought it. That perception has allowed the stock to regain almost all of those lost points, even though it's pretty much the same company it was before the decline in electric vehicle profits. And that's what the Magnificent Seven do. Which brings me to why I'm doing this. The contretemps between NVIDIA and Alphabet, with Alphabet de-emphasizing NVIDIA's chips by relying on its own chips made by Broadcom. Those chips are supposed to be so good that Meta, a competitor, is actually said to be contracting with Alphabet to get its hands on them, perhaps so they can replace the same high-priced semiconductors from NVIDIA. On this news, NVIDIA stock has had the living daylights kicked out of it. Alphabet had been a huge client of NVIDIA, and the press clips say that it's going to adopt its own chips far more than the ones owned by NVIDIA. Alphabet stock has been as hot as NVIDIA stock is now ice cold. It got colder last night when a tech publication reported that Meta is willing to buy these same chips from Google at a considerable savings. Perhaps there could be some license agreement that includes Broadcom, the general contractor for Google's chips, as Broadcom CEO Hock Tan is on the board of Meta. Now you could argue, so what? NVIDIA's got a ton of business, but NVIDIA just reported what seemed like a bang-up quarter. Instead, well, guess what? The stock got banged up. Injured reserve style banged up. NVIDIA was at 186 before the quarter. but then it fell to 180 after its report. Today, it dropped further to 177 on this meta news, down $4.73, but it did fall as low as $169. Now, considering it traded at 212 at the end of October, 169, I mean, that is quite an amount of loss.
The House of Pain.
Let's add a few more indignities to the story of NVIDIA. Meta jumped nearly 4% today because investors bought the stock hoping that these new chips from Google could lead to better gross margins for Meta. That's another Mag 7 about to make a comeback as it benefits from not having to spend a lot of money with NVIDIA, at least the critics say. Now, you could argue that all this is just inside baseball if it weren't for the fact that, well, let's say a couple of other facts. First, the super large customer of NVIDIA. Another one is OpenAI. And that's been the subject of stories about a seemingly precarious balance sheet. Insult to injury, there are short sellers circulating with what I regard as dubious condemnations that include linking NVIDIA to companies with fraudulent accounting that amounted to criminal enterprise. There are people saying that NVIDIA is the next Enron, which I've got to tell you is categorically absurd. So why not just dump NVIDIA if you can't take the pain? All right, I play with an open hand for my trust, so I want to explain why I won't give up on this one. I want to explain why I say own, don't trade the stock of NVIDIA. First, historically, it's been a bad idea to dump any of the Mag 7 out of fear. We sold Google for the charitable trust at a considerable gain, but we left a darn double on the table. I thought Google would be hobbled by antitrust woes and a judge who seemed bent on punishing it as a monopolist. Instead, the judge changed his mind and blessed the company, including the $20 billion payment to Apple to be the sole built-in search provider. I thought the Gemini, their AI product, would cannibalize Google's amazing search margins. No, it complemented them and enhanced them. The only reason I'm not kicking myself is we took our profits from Google and invested them in Broadcom, which has been a really outstanding performer. Still, it was a mistake to throw in the towel because of fear. And you know what? I feel the exact same way about NVIDIA, and I've been thinking about this nonstop since they reported. See, these near-term concerns, they got some validity, of course. I'm not denying them. So did the antitrust action against Google. They most certainly matter, just like the possible cannibalization of Google by Gemini. For all we know, this may be the beginning of the end of NVIDIA's AI dominance. I just don't see it like that, though. With the exception of the bogus accounting charges that I won't even dignify with a response. I wish NVIDIA hadn't alluded to them either, by the way. I think their problems are not insurmountable. In fact, these remind me of the same problems I've heard all the way up from when I liked NVIDIA, when it was just a several $100 billion enterprise instead of the $4 trillion enterprise it is today. I saw so many people leave the stock for so many other reasons that are just like these. That's why I say own it, don't trade it, NVIDIA. So the bottom line, if you don't like NVIDIA, you don't have to own it. Nobody's putting a gun to your head. But let me give you a little coda here, because I'm kind of angry about this. Here's your hat. What's your hurry? And don't let the door hit you on the way out of NVIDIA. Let's speak to Shelley in Virginia, please. Shelley.
Hey, Jim. I love watching you on Squawk and Mad Money. You're the best.
Thank you, Shelley. Hey, Faber's a pretty funny guy, you know? And, of course, Carl's a great, Carl's Rock Gibraltar. What's going on?
My question is on Disney. I've had Disney for a long time. It's gotten pretty beaten down. Is Disney a buy, sell, or a hold?
I think Disney's a hold, and I say that because I think it's too cheap to give away. But I felt higher prices that I just wanted to say, you know what, this thing could go to 95. Maybe I take a look at it there. But it doesn't have the earnings. It had a quarter that everyone thought was good, and it was just hated. What happens if it has a not great quarter? I say look out. I'm going to go to Ken in California. Ken.
Hey, Jim, thanks for taking my call, man. I'll make this short and sweet for you.
All right. No
this company, they got decent cash flow, supports a good dividend, and I'm not sure if I can mention their name, but you got one of the biggest investors out there gobbling up a third of their shares. So hit me with it. What's up with SiriusXM?
All right, look, I think you need to have more car sales. You need to have more growth in used cars. You need to have that before you can just say, you know what, it's time to load the boat up serious. And that's the problem. All right, anyway, look, you can either lean into the AI trade or just stay away. I don't care. Don't like NVIDIA? You don't have to own it. On Mad Money Tonight, Best Buy just hiked its full-year outlook, so could consumer tech be the best new way to play the retail space? I'm checking in with the CEO fresh off the company's report. Then there'll be a lot of publicly traded representation on your Thanksgiving table this week. I'm covering those companies to see if you should carve some space in your portfolio for these names. And up over 40% in the last 6 months, the life science company Agilent, letter A, has been a quiet winner. Could the momentum continue? I'm sitting down with the company's top brass, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This morning, we had a bunch of surprisingly good retail areas with Abercrombie & Fitch and Kohl's flying to the stratosphere. But you know what? We also got a great quarter from Best Buy. That's the world's largest specialty consumer electronics retailer. They posted a 9-cent earnings beat off a $1.31 basis, higher than expected revenue, strong same-store sales. At the same time, management raised their full-year forecast pretty much across the board, which is why the stock jumped over 5% today. So can it keep rallying through the holiday season? Let's check in with Corey Bauer. She's the CEO of Best Buy to find out more. Ms. Bauer, welcome back to Mad Money.
Thank you so much. So good to see you, Jim.
Oh, it's great to see you, Corey. And I'll tell you, so much worked well this quarter. And I kind of want to start with some of these areas of strength because I think the areas of strength are more than temporary. They could be substantive for a very long time.
I think one of the things that we talked about is take computing specifically, 7 straight quarters of positive growth in computing. This is a beautiful, sustained, and we had talked about this before. Innovation isn't always just a light switch. Sometimes it is a long, sustained transition from an older way of, many people bought their computers 5-6 years ago. Now you have some AI features, you have a Windows upgrade, you have an impetus to get out there and maybe get that brand new device, and it creates that nice, sustained demand curve for us.
You know, I also felt that you said something that was really, first time I thought about it. The first time I've heard it, actually, which is the notion that Gen Zs lean into the store experience. This tells me that, you know what, maybe we are misjudging this whole new generation consumer. They want look and feel. They want to touch.
I think they want everything. This is a consumer who's grown up digitally native, so that's easy. I think they're trending toward what are those unique, fun, differentiated experiences. There's lines around the block for Pokemon cards. There's lines around the block for Switch 2. They want to be in the store experiencing the new things. And our goal is whether it's that moment that they want that digital inspiration from a cool influencer or whether it's that moment they want to be in the store to really touch and feel the product, I think it just reinforces the idea that you have to be there for them ubiquitously in all channels.
Now, at the same time, you've done a couple things that are new that I want people to understand about. Best Buy Marketplace, you talked of extensively in the conference call. Sounds like it's working.
We're absolutely thrilled with the ramp that we're seeing. 1,000 sellers, 11 times more SKUs, and we're seeing it do what we want it to do, Jim, which is drive some of that unit demand deeper into our assortment. Many more accessories, many more small appliances. You can have all the color variations, all the team variations, this ability to really appeal to people's unique wants and needs as it relates to consumer electronics. So they don't have to leave us to go get that next purchase. They can get the full basket with us.
Now, you mentioned a couple times you called out the Breville and you also called out Shark Ninja. Now, these are things I know I've seen them at very expensively at other places. Are you offering a great price on these two?
Absolutely. I mean, that our biggest goal here is to offer all budgets an opportunity to get that great gift. And I think Breville and Shark Ninja are wonderful partners and great examples of this, where we can have some great deals on something like a Ninja Slushie, which is just this fun entertainment gift for the whole family to enjoy. And at the same time, you can experience these amazing espresso machines or these beautiful beauty care items. And all of those are really tailored to individual gifting ideas. And in some cases, really interactive displays or some vendor labor that's specialized and really helps the customer get the most out of that purchase.
No, a lot of people would say that those two, especially Breville, are expensive. And yet I think they're going to end up being the holiday gift of the season. Are you seeing that?
Absolutely. What we're seeing is demand across price points. It was one of the things that we talked about on our call. Our growth actually did not come from ASP expansion. Our ASPs were relatively flat year over year in Q3. It came from unit growth, which means more people are finding more items at that right price point. When we talked about computing, we have 134 Copilot PCs. That means you can imagine across that huge assortment, you can find some price point that's going to work, whether you're a student and you just need an entry price point for school, or whether you want that amazing gaming experience and those really high price points. And I think our vendors are amazing partners with us in making sure we can offer any customer that perfect
Well,
gift.
I got to hand it to you. You're one of the few people who recognizes that you have to have both. You can't just turn off some people. You can't say, listen, I don't have the stuff they want. And I also thought it was really bold of you to say, look, agentic doesn't necessarily work with us. We want to hear what the customer's doing. It isn't for everyone. You're obviously very in touch with your customer. You wouldn't be delivering these numbers.
I think agentic shopping will be a part of all of our experience. The question is, when and how do you choose to enter? And I think our teams are doing a really nice job trying to define what does that look like for Best Buy. And it's not just the products we talked about on the call, it's the services, it's the delivery, the installation, it's how you actually show up as an expert. And I think we're putting some extra time into making sure we really feel like we're putting our best foot forward, at the same time prioritizing learning and speed.
Right now, I'm betting that the analysts tomorrow and next week will realize that they misjudged tariffs. They thought it was going to be really hit you. I remember when they came out and your stock dropped from the 80s to the 70s. Looked like it was, people worried about the dividend. It looked like, I'm not saying it was much ado about nothing, but the tariffs did not hit you the way the analysts thought they would.
I think we had a hypothesis going in that we talked about a lot. We are the importer of record on only 2 to 3% of what we sell. And so this conversation is very much in partnership with our vendors. And they came to the table and we came to the table and we worked through a ton of mitigation strategies. Can supply chains move? Can the specs of products change? Can the assortment itself change and double down deeper, maybe with some vendors than others? And at the core of it was this idea that no matter what, we need all the price points that will match all the budgets. This is one of the wonderful things about only working in consumer electronics. Our only goal is to maximize that assortment for every single budget. And there's so many vendor partners that we can work with in order to do that. And yes, we've seen a few price adjustments here and there, but the beautiful part is the consumer can make the call as to what price point they want, and they can still get a great product.
Now, at the same time, like, how do you get put together an IKEA deal? I would never have thought, I'd like to think I'm creative, but that's just that's a terrific touch point.
I think you start with the consumer, right? So what we believe is people don't come to us just because they want a SKU. They come to us because they want an experience. And especially today when you might be really pinched for value and you want to have that very best experience for your family. And so they aren't just coming to put a TV on the wall. They want the living room to be the entertainment center of their home. And when you think about it that way, then look, if I'm shopping and I want that new entertainment experience, I'd love to have a new couch. I'd love to have a TV. I'd love to be able to charge all my devices quickly and easily nearby, or I'd love in my kitchen right away to be able to not only have the fridge, but have the cabinets that match. The more you think about it holistically as solving for really what the customer is trying to accomplish, then I think you come up with interesting partnerships where it can be great for both of you.
Okay, so I'm going to go back to this to different generations. The Z, how do you determine, what do you see? I mean, how do you know that they didn't want to just go to Amazon, that they wanted the entertainment of going to Best Buy?
We have a great team here and an ability, because we can identify so many of our customers, we have a real ability to see what their shopping behaviors look like, both browsing and purchasing and using our services. And we've been able to see a real uptick. It's funny, a lot of people have asked, like, are you seeing only your high-end consumer? Actually, we're mixing even further into our lower-end consumer and our younger consumers. And those two cohorts are also the ones who are saying our brand is resonating even more than ever with them. And so I think it's this ability to, wherever they are, don't ignore the fact that store experiences, that real touch and feel, matters a great deal. And we've been really leaning in. We've talked about that for at least 2 years now, leaning into that store experience, that touch and feel, and partnering a lot more closely with our vendors so that more and more you can go in and see that espresso machine or that TV or that phone or computer and really get a feel for that inspiration you can only get sometimes when you're right in front of it.
Well, look, congratulations. I think this is, you surprised people, and it wasn't just because of Windows 10, and it wasn't just because of Breville, but it's a complete package. And I really like, Gen Z, you seem to be the first to have really identified this. A lot of people think they're very elusive. Obviously not for you. That's Corey Barry, CEO of Best Buy, with a terrific quarter. Corey, I love it when you come on the show. Thank you so much.
Oh, thanks for having me, Jim. It's great to represent this amazing team.
Of course. Mad Money's back in.
Coming up, Cramer's talking turkey and comparing two of the country's biggest turkey manufacturers, Tyson and Hormel Foods, seeing which one can give you the most gains this Thanksgiving. Next.
Look, I don't know about you, but when I sit down for Thanksgiving dinner, I see all the stocks of all the companies that produce the stuff. It's a disease. I can't help myself. My wife, Lisa, she despises it. But sometimes it's useful for what I do here. So let's talk turkey. Yes, there are a few major publicly traded companies that give you a way to invest in turkey. The cleanest option is Hormel Foods, best known for Spam. But it's also the parent of the Jennie-O turkey brand, one of the largest producers of whole turkeys, like the kind you probably have for Thanksgiving. And then there's this Tyson Foods. Now, you probably know them. They don't sell whole turkeys. Even as it does sell a ton of turkey products under the brand names Sara Lee, Hillshire Farms, Tyson is a much better run company than Hormel. Then, let me give you another one, which was brought to my attention by my pal, buddy friend Gemini 3 last night. Seaboard Corporation. This company owns a 52% stake in Butterball. That's the ones my mom always bought, the iconic turkey brand. But it's also got a big pork business and a commodity trading operation, along with cargo shipping, liquid fuels, and even a power production business in the Dominican Republic. While Seaboard's been public for decades and has a market cap of $4.2 billion, it's incredibly low-key. Company has zero analyst coverage, doesn't hold conference calls, and basically just publishes its 10-Qs every quarter to report its results. I never would have stumbled on this thing with one for my chat with Gemini 3. Hey, by the way, Seaboard's stock is up a cool 88% this year. Many of those disparate businesses are on fire right now. Maybe it deserves a full segment down the road. I was kind of intrigued by it. As for the other publicly traded meat producers, like the Brazilian meat giant JBS, which owns a majority stake in Pilgrim Pride, or Pilgrim Pride, and then Smithfield Foods, that's the other one, that turkey, it isn't much of their business. Plus, JBS is a Brazilian company, not going to touch it. Smithfield's basically a Chinese company, not going to touch it. So why don't we stick with the two? Let's stick with Tyson and Hormel. Even though turkey's only a fraction of their business, they're the best publicly traded options we got, and it is Thanksgiving. All right, that's it. Tyson's a much better pick than Hormel. As a matter of fact, I think it's worth going over Hormel. It's really instructive how bad this thing has gotten, because we used to love it. See, Hormel's been a disaster over the past few years. At $22 and change, the stock is down 58% from its peak in early 2022, including a nearly 27% decline this year alone. When the whole packaged food sector came under attack by the GLP-1 weight loss drugs, I thought Hormel might perform better because it's all about protein, right? You need to eat protein on those GLP-1 diets in order to prevent muscle atrophy. It hasn't worked out that way. In fact, when Hormel reported at the end of August, it posted a big earnings miss and a disappointing outlook for the next quarter. The stock plunged 13% in response, and it's drifted lower ever since. Main problem? Hormel's costs, many of which are commodities, they've gotten out of control. There's plenty of demand for their products. Sales growth has been strong. It's just high commodity costs. It's taken a meat axe to their margins. During that last earnings report, interim CEO Jeff Ettinger, welcome back, Jeff, explained how the company's doing everything it can to improve its profitability. But who knows if they can deliver? The other issue? Hormel's searching for a permanent CEO after their old leader retired early. They brought back Ettinger, who served as CEO from 2006 to 2016, had been a regular guest of the show, as an emergency measure. He's got the job for 15 months as they look for a permanent replacement. Look, at the end of October, the CEO left too. CFO leaves, CEO leaves. These aren't good signs. Many mid-level executives have been replaced this year as well. Now, given Hormel's recent performance, I don't necessarily mind the management shakeup, but everything's up in the air right now, and we have no idea if Hormel's new leadership can get a handle on their problems. That said, it is not crazy to believe that Hormel's close to a turnaround. Listen to me on this. Stock's fairly cheap. It's selling for less than 16 times next year's numbers. At its current depressed level, it sports a 5.1% dividend yield. I like that. I like that the company still has good sales momentum. And many of the commodities that have been killing them have indeed started to come down in price. Now, Hormel reports next week, so here's where I come down. I think it's too early to pile into this one ahead of the quarter, given that the CFO just stepped down. I'm not expecting to hear great things next week. I certainly don't expect this interim management team to stick their necks out with a strong forecast. Honestly, I'm kind of hoping that Hormel will disappoint and the stock will get hammered. Why? Well, look, I think management could give us a credible plan for improving the cost structure. At that point, I'd feel comfortable buying this one on weakness, but I want to see the quarter. I don't like guesswork like this. All right, how about the other turkey play, Tyson Foods? Well, I come out pretty strangely on this one. While Tyson's been trading sideways for years, it's held up much better than Hormel. Tyson's been dealing with the same general problems, elevated pressure from elevated costs, with only so much ability to pass on those costs to customers. These are tough businesses, man. But they've managed the situation much better than Hormel. Tyson's been able to steadily grow its earnings for years since the big reset in 2022. Plus, earlier this month, Tyson reported a strong quarter. While the company had a revenue miss, it also earned $1.15 per share. Wall Street was only looking for 84 cents. On top of that, Tyson gave strong guidance for the year ahead, which is why the stock jumped 5% over the next 2 days. It's kept climbing from there. What else has changed here? 10 days ago, President Trump rolled back the so-called reciprocal tariffs on a number of food items, including beef. Is that a good or bad thing for Tyson? Tough to say. Looking at the performance of the company's beef division in fiscal 2025, with the tariffs in place for much of that year, we saw sales up over 5%, driven entirely by a 9% increase in price. On the other hand, the beef segment lost much more money last year than it did the year before, so it's not clear that the beef tariffs helped Tyson, which is why I'm not worried that they're going to go away. Honestly, I like Tyson here. The stock's still very reasonably priced at just under 15 times next year's earnings estimates. Hey, it's got a solid 3.6% dividend yield. More importantly, this company has a much better operator than Hormel. So here's the bottom line. If this holiday week has you thinking about how to invest in the turkey business, there aren't a lot of great options. Hormel Foods and Tyson Foods are probably the only publicly traded companies with meaningful turkey exposure, but Hormel's been a disaster. We got to wait on that one. Tyson, though, you know what? You got my blessing to buy it right now. Hey, why don't we go to Amy in Pennsylvania, where I'm about to be headed soon. Amy.
Hey, Jim. How you doing? Booyah.
Booyah, Amy. What's happening?
Oh, not too much. Thanksgiving week, you know. Get the yum foods.
I love it.
So, I have a question for you about Kraft Heinz. We don't own any of it now. We are wondering whether we should buy into it or just let it go, because it's kind of been a weird one.
You're going to have to let that one go. The fact is that Kraft Heinz, they're bad brands. And you know what? There are such a thing as bad brands. In the old days, there weren't. There was always something that would sell. The new consumer just isn't buying Kraft Heinz. So I don't think you should either. Have a good Thanksgiving. Hey, why don't we go to David in Sweet Home, Alabama? David.
Booyah, Jim and Chill. How you doing?
I'm doing well. How about you, partner?
All is well. Happy Thanksgiving to you, Jimmy.
Oh, same. Same. Absolutely.
So, Jimmy, I have this stock, and I want to know whether I buy more, hold, or sell. It's been creeping upward here lately, and the ticker symbol is EATE. Brinker.
Oh, you know what? I mentioned Brinker just this very morning when I was on Squawk on the Street, and now the stock is up 9. It's been up so many points in the last few days that I will tell you, David, it's too risky, and I think it's the world of it, but I'm not going to have you come in here and then say, Jim, why didn't you tell me the stock was straight up? So we're going to pass on that one right now as much as I like it. If you're looking to gobble up some turkey stocks, you got my blessing to dig into Tyson right here. I'd wait a bit to buy Hormel, though. Much more made money at Agilent was a COVID-era winner, but pulling back from those highs as the company had the pipeline to return to its former glory, I got the CEO. Then it's time to stop the hyper-fixation with tech. I'm sharing how you can build a diversified portfolio filled with growth, because it's possible to find growth outside of tech. Of course, all your calls rapid fire tonight, so just in the lightning round. So stay with Cramer. Last night, we got a very good quarter from letter A, Agilent Technologies, one of the key arms dealers to the life sciences industry. The company reported a modest top and bottom line beat, organic revenue up It's very strong, 7.2%. Wall Street was only looking for 5.3%. Management also gave us robust revenue guidance for 2026, although the earnings guidance was a bit light, but we have to examine that. It wasn't enough to derail the stock. It rallied $3.60, or a little over 2% today. At $157, get this, Agilent's still down a little more than $20 from its COVID-era peak, but it sure feels like this company's finally gotten its groove back, along with the rest of the life sciences industry. So can these guys keep winning? Let's take a deeper look with Padraig McDonnell. He's the president and CEO of Agilent. To learn more about the quarter and what the company's got next. Mr. McDonnell, welcome back to Mad Money.
Thanks, Jim. Great to be back.
Okay, so Padraig, I've been thinking philosophically a little bit about your company. I was worried about the government cutting back, U.S. government cutting back on R&D. I was worried about a government shutdown. But frankly, what else is going on between reshoring and the ability to merge in order to be able to become a more effective company? It seems like this is a great time to be Agilent in the United States.
Yeah, we had a great quarter, and it was driven by most of our markets. You know, we have a lot going on Agilent. We have a unified commercial organization that's really delivering. We have a big transformation and strong innovation, Jim, which is key. On the reshoring benefit, we put out a number which I think is very important. Of the overall 350 or 400 billion that's been reshored, we think our overall addressable market is about 1 billion on that one. So we're very well positioned to capture a fair share as that comes on board in 27.
Now, I think a lot of people felt initially that reshoring was something that was chimerical, not really anything that's going on. Could you tell us how big this can really be?
Yeah, so we think it's a $1 billion of a service addressable market, you know, and you think about a lab and how it's been set up. We're talking to those customers now. They want a lab set up. They want a design early on. That's where Agilent can really help. And they need productive labs. So having the equipment is one thing, but making those labs productive in the US are going to be critical. And that's right in our sweet spot with our workflows and our enterprise service capabilities, where we're actually using AI to help customers to get more out of their equipment.
It seems like what you're designing with AI at a level that most companies would only dream of. I mean, obviously, someone's pretty fast at your company with AI.
Yeah, we're very focused on AI. We're not doing it in 1,000 different areas, but in key focus areas. But in particular for customers, we want to have AI capability in our systems over time. But most importantly, we now have a capability where we can see how a lab is being used and use AI to see when our system's going to go down, long before they go down, and how do you make those assets more productive? And that is really resonating with our customers.
Now, I want to go back to this acquisition, BioVectra. It brings with you a GLP-1 opportunity. Now, I don't want to overestimate if you tell me not to, but it did seem like a $100 million business is a pretty good line of business.
Yeah, it's well over 100 billion, but you're really critical in the GLP supply chain. And if you think about the trajectory of GLPs, there's kind of dual tailwinds. There's high peptide-based injectable testing volumes, but also small molecule orals that are coming on. And these companies need, of course, R&D scale-up and GMP on the analytical side, but BioVectra is critical within those modalities. So we're really servicing customers on the analytical side for testing, and then in the precursors for development with that company.
Are there things going on in testing right now that we haven't really heard of yet? I'm not asking you to violate any confidences, but it just seems like that it seems to work for a lot of different indications.
Yeah, so I mean, a lot of different indications. If you look at our testing, we serve a lot of fast-growing therapeutics, ADCs, oligos, GLP-1s. So our systems are really kind of used in testings in very areas. We talked the last time about PFAS as a critical part of our business as well, and these precursors in GLP-1, it's going to be this business is going to continue to grow for us as the obesity levels for these drugs are really small, and it's only going to grow. So we have a lot of opportunity ahead.
And we haven't gotten our arms yet around all the forever chemicals. I thought that everything was known about these.
Yeah, so we continue to be the market leader in PFAS, and we remain confident of mid-teens growth going forward. And in the year, we grew over 20% in PFAS, and that came from chemical food markets. Environmental, of course, continues as an underlying market. But what we're seeing is broad-based strength across the globe. And one of the areas we're very excited about is air testing, which is becoming more prominent. And we have a real sweet spot with our gas chromatography and mass spectrometry for air testing. And we expect to see a strong growth rate from that.
Now, is air testing done in China or all over the world?
Yeah, it depends, right? So it depends on where the regulation starts. So we're starting to see that in Europe currently at the moment, and that we expect that to expand to most regions.
Well, I know that China is down for most of the company. Look, I speak to Danner all the time. It's been tough, and Thermo Fisher's been tough. Are we about to get to a point where we're annualizing some weaker numbers, and it won't just be something that we have to hear about with a negative number every single time?
Yeah, well, China was flat this year, and we're guiding conservatively for 26, Jim, but our commitment hasn't changed. We have local innovation, we have local manufacturing and supply chain resilience. There has been a lot of talk about stimulus orders. We did quite well in stimulus in 25. Next year, we're waiting to see how that plays out, but it's a standard run rate business for us, about 300 million a quarter. And I think what's really important is that the pace of innovation in life sciences and applied markets supports the demand for instruments and solutions, especially in the space of biopharma, semicon. So we think there's a long road ahead in China.
Is there any sense that I'm trying to get our arms around our FDA and whether is it harder to get something through or more difficult? Because I get the sense there are a lot of people quit at the FDA. It seemed like it was in turmoil, but it hasn't hurt your business.
No, it hasn't. You see a lot of therapeutics being approved. We see that happening all the time. We see it on the analytical side. We see it through our R&D business where we're helping these drugs being quantified and new therapeutics being brought out. And we see a steady release of drugs through it. So from our side, we see that it's going pretty well.
Well, I got to tell you, I really love your pastiche of business. It's fantastic. Not one thing can bring it down. A lot of good things that are happening. I want to thank Padraig McDonnell, who's the president and CEO of Agilent, which is letter A. It's easy to remember. Then money's back after the break.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
Listen up, folks. The clock is ticking, and I'm serious. If you want to learn how to manage your money like a pro, you need to be in the CNBC Investing Club. The special offer to join my team and see exactly how we trade ends any minute. Open your phone, scan the code, or go to cnbc.com/Cramer Club before it's too late. I'm saving a seat for you. And now it is time. It's time for the light round. Our full team is talking about buy, sell, don't know the core stock. Once it's done, step first, the light. Plan to sell. And then the lightning round is over. Are you ready? Skid dad. Time for the light round. I'll start with Luke in Maryland. Luke.
Booyah, Cramer. AUR just hit a 52-week low, but their driver as a service tech haul freight at 75 cents a mile. That's way cheaper than $1 we pay for humans. Is it time?
Well, you know what? Because of your spirited nature and the fact the stock is down that much and is kind of like a dice roll on $4, I will actually bless it. I will bless it. If I see you in the street, remember I bless it. If it goes to $2, not so good. Let's go to Jeremy in Washington. Jeremy.
Hi, Jim. How are you?
I'm doing well. How about you, Jeremy?
Doing good. Hey, I'm a new listener. I just started watching your show last month.
Okay, that's good. I like that.
Yeah. So, considering Cloudflare for a new position, with the stock near highs, should I wait for a better entry point?
No, it's actually, you've had a better entry point. The stock was down after that curious brain freeze, and I think that this stock is a buy right now. Matthew Prince, he delivers. Don't you look at me. I want to go to Bob in Wisconsin. Bob.
Hey, Jim. I'd like to wish you a happy Thanksgiving from northern Wisconsin.
Thank you, man.
Hey, CNBC did a great discussion on the power generation needs for all the AI data centers.
Absolutely.
And one of the smaller what's that?
Yeah, sorry. Absolutely.
One of the smaller companies that I own is IESC.
I got to tell you, there is a stock I want to own. Jeffrey Gendell is the CEO. He is one of the best in the business. I really like him as a person, too. I think that stock's a buy, and you are so smart to bring it to our viewers. I really appreciate it. Let's go to Tyler in Arizona. Tyler.
Hey, Jim. Thanks for taking my call. I'm a big fan of Lightning Round and also really enjoyed reading your new book, too.
Oh, thank you, man. Appreciate it.
Yeah, hey, so I wanted to ask you,
No, it's had some good sales lately. Yeah, I check them by the minute. Yeah. I check them because I had nothing else to do.
Yeah, it's been a great book to read so far. Hey, so I wanted to ask you about a company whose stock has steep sell-off from its highs earlier in the year.
Okay.
It's currently trading near its 52-week low. What are your thoughts currently on Salesforce?
Okay, I think that the disaster is now priced in, whatever disaster there might be, and I'm not going to abandon Salesforce down here at 230. The haters will be haters, but I think it's fine. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, too much tech talk. Cramer's laying out some specific non-tech sectors that could see big growth in the future and giving you tips on how to position for the long term. Next.
The AI horse race consumes us. We know that there's a lot on the line for NVIDIA or AMD every day, but how about if your portfolio is diversified? What if you're in a 5-stock portfolio plus an S&P 500 index fund, with those 5 stocks being diversified into separate growth silos, as I suggest in How to Make Money in Any Market? The answer? You'd feel the AI horse race in one of your stocks for certain, but not all of them. It's a bit of a dartboard out there in tech. Anything in tech could be hit, which is why you diversify your holdings across 5 different sectors, meaning only one tech. What to do with the rest? Okay, the other 4 stocks. Unique growth, and growth can be found in healthcare, in aerospace, restaurants, retailers, you name it. Why these kinds of stocks? Because growth stocks do well in any environment, and they're turbocharged when interest rates go lower. Given that the Fed's now expected to continue cutting rates at its December meeting, based on a soft set of economic numbers we got this morning, it's going to be a good time for growth. After this set of numbers that I saw this morning, I think we're pretty darn close to the scenario where Fed Chief Jay Powell has no choice but to recommend a rate cut. In other words, won't even be an issue. So let's use today's action to see how you could skate past the worries of this moment. Like many of you, my charitable trust owns NVIDIA. I could wallow in NVIDIA. Woe is me, the pain, the horror. Or I could say that's fine. I also own Eli Lilly too, so I can handle that pain. Lilly may have the greatest drug franchise of all time with its GLP-1 weight loss and diabetes medication. Might also be great treatment for hypertension, even alcoholism. You could own J&J and Merck with their incredible franchises. You know what? I'm actually particularly fond of J&J right now. They're spinning off their commoditized artificial joint business. Then there's retail. Well, we like TJX and Costco for the charitable trust. Those are 2 growth retailers with excellent numbers. TJX is at its high, has tremendous momentum. Costco is not far from its low, amazingly, and while it's never cheap, I think this is a terrific moment to buy it. Walmart still looks good after that great quarter last week. I like Dick's Sporting Goods after they cut margins to move all the rest of that bad inventory from Foot Locker, which they bought earlier in the year. I hope you enjoyed Best Buy as much as I did. That one's suddenly pretty interesting. Restaurants intrigue me now that we're seeing commodity prices getting hit. I'm particularly partial to any chain that's been willing to sacrifice margins to keep customers coming. You know what that means? It means Brinker, symbol EAT, parent of Chili's, an investing club holding Texas Roadhouse. Wow. The latter's more levered to steak than any other chain, and its sales have held up because its refusal to take price hikes lest it alienate its core customer. So now that steak prices are coming down because the president has cut the tariffs on Brazilian beef, Texas Roadhouse should see its gross margins explode, and I don't care that it's up about 10 straight points. Now, there are a lot of all sorts of growth areas out there that are working, including travel and leisure, life sciences, or aerospace. There are plenty of opportunities. You heard Agilent earlier, so stop wallowing in just tech. Pick 4 stocks that aren't tech and have a very good day. I'd like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.